Understanding Return on Investment, ROI. A comprehensive overview. Return on investment, ROI, is a crucial performance metric that serves as a yardstick for evaluating the efficiency or profitability of an investment. By measuring the returns relative to the investment's cost, ROI provides a straightforward way to compare various investment opportunities across different sectors and projects. What is ROI? In simple terms, ROI reflects the profitability of an investment by indicating how much money has been gained, or lost, from it. The basic formula for calculating ROI is ROI equals current value of investment, cost of investment, / cost of investment. The result can be expressed as a percentage, allowing investors to gauge the performance of one investment against another easily. Key components of ROI calculation. 1. Current value of investment. This encompasses the total proceeds from the investment, including any cash flow it has generated over time. 2. Cost of investment. This includes the initial amount invested along with any ongoing maintenance or operational costs. Example of ROI calculation. Consider an investor, Joe, who invested $1,000 in Slice Pizza Corporation and later sold the shares for $1,200. To calculate the ROI. Net profit equals $1,200, selling price, $1,000, initial cost, equals $200. ROI equals $200 / $1,000, equals 0.20 or 20%. In contrast, if Joe invested $2,000 in Big Sales Stores Incorporated, selling it for $2,800 years later, the ROI would be calculated as follows. Net profit equals $2,800 to $2,000 equals $800. ROI equals $800 / $2,000, equals 0.40 or 40%. While direct comparisons show that Big Sales Stores has a higher ROI, it is essential to consider the investment duration to make a meaningful assessment. Why is ROI important? Versatility. ROI can be applied across various asset classes, from real estate to stocks, allowing for easy comparisons. Simplicity. The straightforward nature of its calculation makes ROI a favored metric in financial analysis and reporting. Profitability indicator. By showing the rate of return, ROI helps investors in judgment calls, whether to proceed with or abandon an investment. Limitations of ROI. Despite its advantages, ROI has significant limitations. 1. Time factor. ROI does not account for the time dimension of an investment, which can lead to misleading conclusions when comparing long-term and short-term investments. 2. Opportunity costs. ROI doesn't consider alternative investment opportunities that the investor might miss out on during the investment period. 3. Inflation impact. ROI calculations do not factor in the diminishing purchasing power of money, meaning real returns might be lower than those indicated by ROI. To mitigate these limitations, investors often use other financial metrics, such as the rate of return, ROR, net present value, NPV, and internal rate of return, IRR. What constitutes a good ROI? While there's no standardized benchmark for a good ROI, several factors come into play. Risk tolerance. More risk-averse investors may find satisfactory returns at lower percentages, while risk-tolerant investors may pursue higher ROIs despite greater uncertainty. Investment duration. Long-term investments typically demand higher ROI thresholds to be considered attractive. Industry norms. Different sectors have varying expectations for ROI based on market conditions and capital requirements. Investor goals. Individual financial objectives greatly influence what is deemed a satisfactory ROI. Emerging forms of ROI, social return on investment, SROI. With a broader focus on sustainable growth, social investors have developed a new metric known as social return on investment, SROI. This metric evaluates not only the financial returns of an investment but also its social and environmental impact. By incorporating extra financial metrics, SROI provides a more comprehensive picture of an investment's value. For example, a company might invest in efficient waste management practices that yield immediate costs but provide long-term benefits to society and the environment, showcasing a positive SROI despite a lower conventional ROI. Other variants of ROI. Marketing ROI assesses the effectiveness of advertising campaigns based on sales generated. Learning ROI evaluates the returns on training and education investments. Social media ROI measures the effectiveness of social media efforts in generating engagement. Conclusion: ROI remains a vital tool for investors aiming to assess the profitability of various investments. While it provides valuable insights into performance, its limitations prompt a need for additional metrics considering time frames, inflation, and social outcomes. By understanding ROI and its implications thoroughly, investors can make more informed decisions that align with their financial goals and risk profiles. Reserve a moment to evaluate your investments and calculate your ROI, diversifying your analysis to encompass both traditional and emerging metrics to ensure future success.